In our next entry, Cleanmore Appliance is going to declare a dividend. So when you sell ownership in your company, your owners, your shareholders, want to see the company increase in value. They want the price of their shares to go up. But in addition, typically, they're going to want to see a portion of the profits. Like if the company makes profit, they own part of the company, they should share in a portion of that profit, and that is our dividends. So here on March 15th, Cleanmore Appliance is going to declare a 40-cent per share dividend on its common shares and a normal quarterly dividend on its preferred shares. This is just our date of declaration. We're saying in the future that we're going to pay these dividends. We're not paying them right now. But we are going to set our other two dividend-related dates at this time. First one being the date of record, which tells our shareholders that if they want to get that dividend coming in the future, they have to own it by this cutoff point. And we've set that date of record as March 22nd and declared that we are actually physically going to transfer the cash for these dividends on March 30th. Well, what's going to go on here? Well, on March 15th, what are we going to put in our journal entry? We are withdrawing funds from our company to give them to our owners. And at the time you declare, even though you haven't paid it yet, GAAP policy says that is when you have to make the formal withdrawal from your books. So we're going to start by debiting our withdrawal account as a corporation, which in this case, since we're paying cash, is cash dividends. Secondly, we're saying we're going to pay these in the future. We're committing ourselves to this, which means we're liable to have to pay these dividends in the future. So we are going to make a liability account for our dividends called dividends payable. Since we have two different classes, we're going to make two of these. One for our common shares, which we're going to call dividends payable common, and one for our preferred shares, which is dividends payable preferred. Now we got to figure out what these numbers are going to be. We'll start with our common shares. What is the amount of liability that we're going to have with our common shares? What's our credit going to have to be right here to dividends payable common? Well, that's going to be for the total amount of shares that the public owns at this time, our shares outstanding by accounting terms, times the rate at which we're paying. Well, we know the rate's 40 cents. So now what we got to do is we got to backtrack through our transactions. We have to figure out how many shares of our stock the public actually has in their hands as of March 15th when we are making this transaction. So let's scroll up and figure out what went on. We authorized shares, but we didn't actually issue those. Like those 2 million shares of common that were authorized right here aren't actually in the hands of our shareholders. That's irrelevant to our calculations right now. But here we did actually issue some shares. We issued 400,000 shares. So on January 1st, after we issued that, the public owned 400,000 shares of our stock. I'm just doing common right now. We'll go back to preferred later. See if we have any other common stock transactions, and we do. Over here on January 2nd, we issued a further 600,000 shares. So after we made this issuance on January 2nd, the public had the 400,000 shares from January 1st, plus the 600,000 shares from January 2nd. There was 1 million shares in the hands of our shareholders at that time. We, however, had a couple of transactions related to our own stock where we repurchased some of it and we sold it. So out of those 1 million shares, they're probably not all in the hands of our shareholders right now. Let's scroll down and find our treasury stock transactions. And if we scroll down, we have one here. We repurchased 100,000 shares of our own stock, which means those shares were no longer in the hands of our shareholders. From our two issuances in the beginning of January, there was 1 million shares in the hands of our shareholders. We just bought back 100,000 of them. So after we made this repurchase, there was 900,000 shares of our common stock outstanding. Scrolling down through, we sold some of those shares back. We sold 75,000 shares of our stock out of our treasury back to the public. They had 900,000 up here on February 1st after we made the repurchase. We just gave 75,000 of those back. 75,000 of them went back out into the hands of the people. There's now 975,000 shares of our treasury stock outstanding. And we have no other transactions related to our common shares, so we take the shares outstanding, 975,000, and we multiply that by $2.40. So for your common dividend, that comes out to $390,000. For your common dividend, that's your process. Go through, add together all of your common shares issued, subtract out any treasury shares purchased, and add back in any treasury shares resold. You're essentially just going through the steps, looking at your records to figure out how many shares the people have at this time. You need to do this the same way for preferred shares. And in this example, we got it pretty easy. We made 0 treasury transactions related to our preferred shares. They're all common. So all we really need to do is figure out how many shares of preferred stock we put in the hands of the people in the first place. We only had one transaction. On January 2nd, we issued 50,000 shares of preferred stock, and it should be noted that this preferred stock was $25 par with a 6% annual rate attached to it. Well, now we got to pay dividends on all 50,000 shares, and those dividends will be based upon the $25 par value of the shares and the 6% rate. So if I scroll back down to our declaration for preferred dividends, I am going to take the number of shares outstanding, again, scrolling back up one more time, that is going to be 50,000. I'm going to multiply it by the par amount. I'm going to multiply it by the stated preferred rate. But since that is for a year, I'm going to multiply one more time by the portion of the year that's actually passed. So we have down here 50,000 preferred shares outstanding. Those preferred shares have a $25 par. We multiply that. The stated rate on those shares, which we have outstanding, that we have to pay for, is 6%, 0.06. And since that's for the year and we're making a normal quarterly dividend payment on preferred shares, I'm going to multiply that by a quarter. And I'm going to come up with $18,750 at this time. So if we add those two numbers together, the total amount of money that we are handing out to the public is equal to the sum of what we're declaring for common shares and the sum of what we're declaring for preferred shares. Totals up to $408,750 here. That's crazy that it keeps doing that. We declared cash dividends. We set a date of record is March 22nd. That is the day that we said people have to own our stock by if they want to get that dividend on March 30th. And we did so a whole bunch of people didn't wake up in the morning on March 30th, buy our stock just to get the dividend, and then resell it later in the day. That would do terrible things to our stock price. You want to have some consistency with ownership. So we are going to go through and declare a date of record that they have to own by. But on that date, nothing changes with our books. Like, that was the deadline that we set in there. But we're not actually paying anything. We don't need to increase our liability. We already have it on the books. So again, no entries required here since nothing is actually changing hands during our transaction. You could write no entry required down here if you wanted to in the description. Or if you want to, you can make a memorandum entry. We'll call this a memo. And here I'm going to write in the description that this is the date of record for the March 30th dividend. Then March 30th rolls around, 3/30. We have to actually pay those dividends. Well, if we do so, we're no longer going to be liable to have to pay them in the future. We met our obligation to our shareholders. So those two liability accounts are dividends payable common and our dividends payable preferred are going to come off the books. And they're going to come off for exactly the amount that we said we're going to pay. $390,000 for common shares and $18,750 for preferred shares. We are actually paying these this time. So our credit is going to be to cash. We need to reduce our cash amount by the sum of the amount of common dividends we owe and preferred dividends that we owe, which is that same $408,750. So in the process, the three-step process for dividends, at the time of declaration, you use cash dividends, which is actually your withdrawal account, to reduce to denote, I should say, in your books that you are taking that much money out of your company to give to your owners. But when you actually give them the money, that's when you reduce your actual cash account. And here we paid a previously, it's spelled previously correctly, previously declared cash dividend. Down here on our next entry on March 31st, we're going to make our first quarterly payment on our note payable. Well, we did the amortization table for this way back in the beginning of this thing. We have all the numbers that we need. We see that on March 31st, when we make our first payment on our note, if I scroll up to the notes table, that we are going to pay a total of $68,000. $50,000 of it's going to go towards principal, and $18,000 is going to go towards interest. So on our books, to account for that, the amount that goes towards principal reduces your liability. We're going to need a debit to notes payable. Liabilities go down with the debit. The amount that goes towards interest is going to get recorded as an interest expense, and the total amount of your payment is the total amount of cash that you're going to transfer, so we're going to credit cash. And then we can just go to our chart, to our amortization table, and reference those numbers. Notes payable on March 31st, $50,000 is going towards principal. The interest expense is equal to, back to our amortization table, the $18,000 that we calculated earlier, and our total payment is going to be for $68,000. And here we made our quarterly note payments. We have one more type of outstanding debt kicking around that we need to pay for, and that is our bond. Setup is going to be exactly the same as before, but this isn't a notes payable. It is on our bond. We're not going to reduce the value of bonds payable. By the way that the nature of the bonds work, you don't repay the lump sum, the principal, until the very end. We're not reducing our principal obligation. These bonds, if you would go back and check the numbers, have a face value of $2 million. We owe that all at the end. So what accounts are going to be affected here? Well, let's go and look at our amortization table for the bonds and see. We had an interest expense. We're probably going to need that in there. We had our discount or our premium, which we're amortizing. We're going to have to account for that in the journal entry. And we're paying out a chunk of cash to our people. So our three accounts being used are interest expense, in our case, premium on those bonds payable, and cash. So if I go back over here, let's just go and set that up. We have interest expense. We have premium on bonds payable. That account went on the books with a credit, so to reduce it, we're going to have to debit it. And then lastly, we need to reduce our cash. And the numbers you can go and find on your table. Interest expense is equal to the $37,000. The amortization amount for that premium on bonds payable, if we go back over here, was $3,000. And the actual amount of cash that we were going to transfer for this payment is $40,000. And here we made our quarterly bond interest payment and amortized our premium. Down here on March 31st, we are going to make our third monthly payment on our mortgage. We've been making this entry over and over again. The numbers are going to change. The accounts are always exactly the same. So I'm going to hit equals in the very first line for the account name. I'm going to go back up until we've had our last payment on our mortgage, which occurred right here. And we know that it's a debit to mortgages payable, a debit to interest expense, and a credit to cash. Now that I have that highlighted, I want to bring it down. So I'm just going to hit enter. And then I'm going to fill handle in all of those accounts. There's our journal entry. So what are the amounts? We have our amortization table. This is March 31st. So mortgages payable is the amount that we're going to reduce our principal balance by. Let's go to our mortgages payable thing. And on March 31st, we see the principal portion of that is $6,558.02. Let's debit mortgages payable by that amount. We hit equals for interest expense. We go back to our amortization table for that March 31st payment. The amount of interest that we are going to have to recognize, because the bank's taking it, is $14,934.91. And the total amount of our cash payments, since this is a fixed payment, is consistent with what it always is, $21,492.93. And here we made our March mortgage